Bitcoin just hit a weekly RSI of 25.6. That is the most oversold reading in the entire 17-year history of this asset. And every mainstream financial headline right now is pointing to the same conclusion: institutional money is abandoning Bitcoin. They cite $4.5 billion in net outflows from US spot Bitcoin ETFs since January. They point to BlackRock's IBIT shedding $2.1 billion in 5 weeks. They show you a fear and greed index at levels only seen a handful of times in crypto's entire history. The narrative writes itself. Wall Street came, Wall Street saw, and now Wall Street is leaving. Except on February 26, while those outflow headlines were still printing, blockchain trackers flagged something that completely shattered that narrative. BlackRock executed a $289.6 million spot Bitcoin purchase in under 1 hour. The very same week IBIT was making outflow headlines. On-chain data showed 4,390 Bitcoin moving from Coinbase Prime directly into IBIT custody wallets in a series of coordinated transfers spaced minutes apart. So either the biggest asset manager on the planet has no idea what its own fund is doing, or the story being told about institutional abandonment is dangerously incomplete. Today on Web3 Verse, Alex is breaking down exactly what is really happening, and why the headlines are only telling you half the story. Let's get into it. First, let's look at the data that has retail investors genuinely terrified right now. Since the start of 2026, US spot Bitcoin ETFs have logged nearly $4.5 billion in cumulative net outflows. The 5-week outflow streak, the longest since early 2025, accounted for approximately $3.8 billion of that figure. BlackRock's IBIT led the decline, shedding roughly $2.1 billion. Fidelity's fund saw over $954 million exit. Meanwhile, Bitcoin's price has fallen 47.6% from its all-time high reached in October 2025. On February 6, the Crypto Fear and Greed Index hit a reading of 5 out of 100. To put that into context, the index bottomed at 6 during the FTX collapse. Sentiment right now is worse than in the wake of one of crypto's most catastrophic institutional failures. When algorithms see ETF outflows of this magnitude, they do exactly what they are programmed to do: interpret the data as a signal that institutional demand is collapsing and pile into short positions. Retail investors watching their portfolios bleed red capitulate into a market already gripped by maximum fear. The machine feeds itself. The narrative is clean, simple, and emotionally compelling. The problem is it is only looking at half the picture. To understand what BlackRock is actually doing, you need to understand the plumbing that sits underneath the ETF system, plumbing that most retail investors have no idea exists. BlackRock does not buy or sell Bitcoin directly from your brokerage account. Instead, a set of specially licensed firms called authorized participants sit between the public market and the ETF itself. These are the only entities permitted to create or redeem IBIT shares directly with BlackRock. When retail investors sell their IBIT shares on the secondary market, those shares can pile up at a discount to the fund's actual Bitcoin value. An authorized participant buys those discounted shares, bundles them into a redemption basket, and presents them to BlackRock in exchange for the underlying Bitcoin. Bitcoin moves from IBIT wallets to the authorized participant. The authorized participant takes that Bitcoin to Coinbase Prime. BlackRock records the day as an outflow. The headline reads massive institutional exit. The headline is not wrong, but it is describing a mechanical contractual settlement process, not a mass exit of institutional conviction. Now layer on top of this the cash and carry basis trade, and the picture gets significantly more complex. For the past 2 years, a substantial percentage of capital sitting inside Bitcoin ETFs was never there because someone believed Bitcoin was going up. It was there because the price difference between Bitcoin spot and Bitcoin futures on regulated exchanges was generating annualized yields as high as 15 to 30%. An institution buys ETF shares on the spot market and simultaneously shorts Bitcoin futures at the higher futures price. The gap between those two prices is essentially risk-free profit. The ETF share is not a conviction bet, it is inventory in an arbitrage strategy. When futures premiums compress and the spread narrows, the entire trade unwinds simultaneously. The institution redeems its ETF shares, closes its futures short, and the published flow data shows a massive outflow. Research analysis found the correlation between basis compression and ETF outflows sits at nearly 0.9. That is not a loose association, it is a near mechanical relationship. Between 20 and 35% of all capital that flowed into Bitcoin ETFs was there for the basis trade, not directional Bitcoin exposure. But here is the harder question the outflow data is actively masking. Because while the basis trade mechanics explain the headline numbers, they do not explain who is accumulating the Bitcoin that leaves these ETF structures. And that is where on-chain supply data tells a completely different story. Exchange reserves of Bitcoin have fallen to approximately 1.8 million BTC, the lowest level since 2017. Over 171,000 Bitcoin were withdrawn from major exchanges in the weeks following the US election cycle in late 2025. Long-term holder supply currently sits at roughly 14.4 million BTC, approximately 72.7% of all Bitcoin in circulation. These are coins that have not moved in over 155 days. They are not moving into fear or panic. They are not moving anywhere. Meanwhile, wallets holding 100 BTC or more are approaching 20,000 in number. Accumulator addresses have absorbed roughly 372,000 BTC since late December, a rate of accumulation historically associated with cycle bottoms, not cycle peaks. The most recent on-chain data showed Bitcoin whales net purchased approximately 270,000 BTC over the past month alone. At current prices, that is roughly $23 billion worth of Bitcoin quietly swept up while retail investors panic sold their ETF shares. That is the largest net whale purchase in over 13 years. Now hold both pictures simultaneously. On one side, ETF outflow headlines screaming institutional abandonment. On the other, on-chain accumulation data showing the largest whale buying event in over a decade. Those two things are perfectly reconcilable once you understand that the capital leaving through the ETF door is largely basis trade arbitrage unwinding, while an entirely different class of institutional money is entering through the over-the-counter door, completely invisible to published flow data. OTC trading volumes surged over 100% year-over-year in 2025. None of that shows up in ETF flow reports. All of it shows up on the blockchain if you know where to look. Bitcoin's weekly RSI at 25.6 has only appeared at two comparable moments in history, during the 2018 crash and during the 2022 collapse following Three Arrows Capital. In both cases, the extreme oversold reading preceded the final capitulation flush before a structural recovery began. Crucially, the current drawdown lacks the systemic contagion features that define 2022. No major exchange collapse. No algorithmic stablecoin implosions. ETF infrastructure fully intact with over $84 billion in total assets under management. The 200-week moving average, which has marked the absolute bear market floor in 2015, 2018, and 2022, is currently holding as support. Bitcoin has not breached it. The ETF outflow headlines are not lying to you outright. The outflows are real and historically significant. But the structural driver is the mechanical unwinding of basis trade arbitrage positions, not the mass exit of long-term believers abandoning Bitcoin's thesis. Patient capital is accumulating while impatient capital exits at a loss. The asymmetry of information between what the headlines report and what the blockchain actually shows is not accidental. Retail investors who read only the headlines are bearing the full cost of that gap. That is everything for today on Web3 Verse. Drop your thoughts in the comments and we will see you in the next one.